So welcome everybody. We're looking at a chart here of for some reason this keeps bouncing back to something else. I don't know why it won't stay on my chart here. All right, so let's talk about breakouts. Okay, I find that not only are breakouts the most popular way to enter a market for people, but they're also the most challenging. They also seem to lead to the most losses. Okay, people that just jump into markets and just decide that they're going to be breakout traders. Not everyone, but the vast majority end up being the ones that have the most losses in trading. Okay, and I'm not just talking about dollar losses. I'm talking about your win to loss ratio. Okay, or in that case, I should say your loss to win ratio. For most people that take breakouts, it's pretty high, and there's a reason for that. Okay, it's because whether they know it or not, they're taking a shortcut in learning how to do this that you can't really take. Okay, there's a much better, much lower risk, and much lower stress way to take a breakout. That's going to be the topic of our discussion today. We've got some timely breakouts here to deal with in real time as well, which is nice for today's session. So what I thought we would do is spend a good half to three quarters, about half of today's session, maybe a little bit more, on learning how to do this, and then the other half, or however much time we have left, we should have plenty, actually looking at some live trades on live markets. As you know, the Forex markets are some of the biggest moving markets in the world, if not the biggest moving markets on a regular basis. Breakouts are every single day in many different pairs, in many different directions. Okay? Now, let's back up here. Let me just back up for a second. Just a quick little note on who I am for those who don't know. I recognize a lot of faces in here. My name is Sam Seiden, and just a real quick recap. I didn't start my career trading, and I didn't start my career in the trading education world. I started on the floor of the Chicago Mercantile Exchange in the foreign exchange quadrant, handling currencies, specifically handling order flow from big banks, dealer desks, institutions, hedge funds, things like that. And I did that for about over a year before I even thought about trading. Okay, and obviously that led me into trading. And but coming from that background and only that background, not knowing anything about trading or markets or currencies when I started, while it was a little intimidating at the time, it was really a big blessing in disguise, looking back on it now, because not knowing anything forced me to see things for what they really were. Okay? And when you start your career looking at institutional and bank dealer desk order flow, you understand and see exactly how and why prices move. Okay? Facilitating that order flow meant handling big orders, putting them in the market, okay? Things like that. A little issue there with the platform, okay? Now, all I would see every day are all these orders. And I could tell you, to keep it real simple, the only time prices would move from one price level to a next is when things were out of balance. Okay? That's like anything in life. The only time you're going to get movement or change in anything is when a balanced equation becomes unbalanced. Okay? It could be anything. Could be anything you could almost possibly think of. Okay? It's no different here in the markets. I think people have really lost that perspective over the years. Now trading on charts has become some kind of art with fancy indicators and oscillators and chart patterns and things like that, when really the underlying reason why prices move in any market has not changed at all and never will. It's an ongoing equation with supply and demand. Okay? All right, and that is really the basis, again, to what we're going to be talking about today. So when things become, when supply and demand at a price level become out of balance, prices move and you have a breakout. That is not necessarily when you want to actually jump into the market. Okay, Ed. Yeah, I would say that and only that is the reason why I've had so much success for so many years is because of that. And I've only noticed that because over the years, especially in the late 90s, you see people come into the market that have absolutely no idea what they're doing. And most of the people that just take a little bit of education end up just going to the store to read a book, right? Most people start their trading career reading a book at the bookstore. And which book are they going to pick? They're probably going to pick the one that sells the most copies, written by the author that writes the most books. So are they learning to trade from a trader, or are they learning to trade from someone who knows how to write books? You see my point? And I don't want to pick on anyone specifically. That's kind of the whole trading world right there. So you just have to be careful with that. Okay? All right. So let's take this euro, for example. Let's just dive into the real market here. Now the euro, notice we just had prices, we just got out of a period where prices were moving relatively sideways here. Let me just put some lines around this area. Okay, we'll just put some lines around this. And notice we just had a breakout. Most people would say, wow, we need to jump, should have jumped into this. Okay, this is the long entry. The euro's been down for so long. And finally, we have a breakout out of an area of congestion. Okay, I would never, ever, ever take this trade right here as is, and the reason is because first of all, the breakout, the move higher, and the candle closing as it does tells me. Oops, sorry. Let me grab that again. You should be able to see it, Darko. Let me just grab that screen again for you. How about that? You see that now? Okay. All right. Good. So I shouldn't. Yeah. So prices take off out of that level, but remember, as soon as supply and demand becomes out of balance, prices are going to shoot higher. Okay. So if you're watching a chart, let me back up. If you're watching the order flow on a trade desk like I was, you know when that's going to happen. You have the buy and sell orders in front of you. So if I have a ton of orders to buy at this price level, and a smaller stack of orders to sell, I'm watching that. And as soon as the last seller sells, and we have no more sell orders at that price level, and we have a lot of demand or buy orders left, what's going to happen to price? It's going to go up. Okay, that's what always happens. It has to. Okay. So if you have the order flow in front of you on a trade desk or a bank dealer desk, you see that happening ahead of time, right? You know when that's going to happen. If you're watching a chart, you don't, okay? But that's okay, not a big deal, because instead of jumping into this breakout and jumping in on this big green candle, we let the green candle happen. We let the green candle close, because when that green candle goes up and closes as it does, that tells us that there is more demand than supply at the origin of that breakout. Does everybody understand that? Okay. So the breakout of that candle, letting it happen and watching it and not doing anything, tells us that demand exceeds supply at the origin of that breakout. Is that clear to everybody? You can let me know. That way I know everybody's kind of on track here. All right, great. So let it happen. Most people are uncomfortable letting it happen. They feel like they're missing something. You're not missing anything. Instead, you're getting the very clue that you need for a low-risk entry right around the corner. Okay? Exactly, Din. That's where we're getting to now. So you want to let price break out, and then typically let price come back to the level, and that is your low risk, low stress, higher reward, and high probability entry. Okay, we'll see that in a moment. Now, why don't I want to jump in this first move? A number of reasons. First of all, if prices don't, break out and close as they do here, I don't know that demand exceeds supply at that level. I don't know that it's worth jumping in. Secondly, if I bought on this breakout, look at the candle just before it. You also probably would have bought there and lost money, right? And you probably would have bought the candle before that and the candle before that. You see what I'm saying? So let it happen. Now I'm going to circle another area here to the left, and then I'll grab the chart again so you can see it. Nev is asking a good question there. What if price does not retest the origin of the breakout? I don't think I've ever seen a time where that didn't happen, Nev. Sometimes it takes a little bit longer than others, but that's not necessarily a bad thing, and often that's a really good thing. Okay. Often the longer it takes price to come back to the origin of that move, the better. Okay. So price will almost always come back, and again, you learn that also on a trading floor or on a trade desk, because who's the buyer at the origin of the demand? Okay. Who's the origin of the buyer at the demand? Is it the retail public, or is it probably maybe a bank or institution? Who's the buyer down there? Right. It's right. It's usually the groups or people with the big money, the consistently profitable buyers and sellers. So they have every reason to do what they need to do to get price to come back, and it always does. Okay. All right. So that area I circled to the left. Here's another reason why you don't always just want to jump in and buy a breakout. Now, there's a time and a place for just buying a breakout before the pullback, but we'll go over that in a little bit. Okay? So that circled area, notice prices fell out of that circled area. Why did they fall out of that circled area? Why did they fall out of there? There's only one reason why they fell out of that area. Right, Darko's got it there, because supply exceeds demand. Exactly. Nice job, everybody. Supply exceeds demand there. There's more sellers and buyers in that circle there, so price dropped out of that area. So again, all the more reason why we do not just want to buy a breakout of this cluster of trading that comes up next towards the right of the chart. In between my two lines, that's why we don't just want to buy a breakout, because this is why most people, what I'm getting to right now is why most people lose money buying breakouts, because they fail to look to the left. And looking to the left really has to be the theme of this, of what we're talking about today. You need to look to the left and see what you're breaking out into. Is price breaking out into a pocket of kind of clean air, which suggests it could keep going? Okay. Or is price breaking out into an area of supply or resistance, like it is here in the euro? Okay? The difference is everything. The difference determines, whether you're likely to make money in that breakout trade or lose money. Okay? You don't want to be blindsided by an opposing supply level like we have here. All right? So when you're breaking out into a cluster of supply like we have to the left here, all right, we do not want to just buy the breakout. Instead, we want to wait for a pullback to support. Okay? Does everybody understand that? Okay, excellent. All right, so that's the big thing there. Now, if price is breaking out and there is no supply to the left so much higher, that's a trade we could take. Okay? Yeah, and Hamish is asking a quite good question there about orders and stuff. Remember, Hamish, most of the consistently profitable traders, a lot of them, at least at the institutional level, have their orders in ahead of time. it's very rare that a giant order is just going to be, someone's going to call up the trade desk and put a big order in. Most of those orders are sitting there and they're kind of working orders. Okay, and they can do that because they're not chasing moves. They're buying at support, selling at resistance, buying at demand, selling at supply. Okay. Snool, it's not the same orders lasting so long. It's not the same orders down there. That's not at all what we're suggesting. This is just showing you kind of the aggregate picture of where the willing buyers and willing sellers are. I wouldn't say at all that it's the exact same buyers and sellers. Okay? All right, so on this euro going forward, instead of just buying here after this breakout, it's probably a better idea to wait for a pullback to support. Okay? All right. Okay, so let's move on here. So we kind of did it backwards. We kind of looked at a live chart. Now we're going backwards, but we'll look at more live charts. Okay. So I just switched the screen, and just to make sure everybody can see that. Can everybody see that I just switched the screen or no? All right, here. Let me. Oh, there we go. Okay, now you should be able to see it. Yeah, we'll get back to that euro in a little bit. We'll look at another chart with that. Okay, so let's just take a look at some examples here. Let me. So right in the middle of the chart, you see we have a horizontal black line here. Can everybody see my mouse moving? I'm not sure if you can see my mouse moving. Yeah. Okay. Great. So we have a black line here that, for a little while to the left, is, if you look at the beginning of the black horizontal line, it serves as resistance. But notice prices here break out. Just to the right of that, prices come back up to that resistance, and we have a breakout right in the middle of the chart. Okay, a lot of people are going to look to buy that breakout. But again, the problem with the breakout, just like that, is that first of all, you only know it's a breakout after it happens. So entering a trade just as prices are breaking out is usually not going to be low risk or low stress. Okay? So you only know it's happening after it happens. So you're certainly not getting in on this first breakout green candle, because you don't know it's a green candle until after it happens. Okay? So instead, you're probably getting in on the second big green candle, and then price comes back against you. It's just not a low stress, low risk way to have a trading career. So instead, let prices break out, and eventually, when they come back to the origin of that breakout, that's where the whole supply-demand flip or shift happened. Okay? There is a shift in the supply and demand. The breakout from what was resistance tells you that it's very low risk to buy on the first pullback. All right? That's the way you want to do it. Okay? Demand exceeds supply there. You want to buy where demand exceeds supply, because at price levels where demand exceeds supply, that's where they're going to turn higher. Okay. Another thing we could talk about on this chart. Okay. All right. So another thing to talk about here is, notice the breakout, the kind of the origin of the breakout. Prices go up for 2 or 3 candles, then they come back, drift sideways, and then they rally up, and then they come back to the origin of the breakout, right? So a lot of kind of choppy candles in there. And what I'm going to go over now is important for you to understand, because I think hopefully it'll take you to a level of understanding that's a little bit better than your competition, which is crucial in trading. So notice the number of candles here. Notice the number of candles here on the breakout. Tons of candles on that breakout. But then notice after where we want to enter, which is the pullback to the origin of the entry, it takes very few candles for price to go higher. Okay? You're going to see that most of the time, right? After the pullback to the origin of the breakout, prices shoot up very quick. This is because, okay, this is because at the breakout here, the people that are buying are doing all the dirty work for us. They are removing all the significant supply, all the sellers that are present on this breakout are being absorbed at least up to the high of where I have my arrow right now. Okay, so all the kind of the original buyers there on the breakout are doing a lot of work for us. They're removing or absorbing all the significant supply, so that when we get in on the pullback, okay, when we get in on the pullback to the origin of that breakout, there's very few sellers left, at least up to the high of the origin of that move. Right? Does everybody clearly see that? Yeah, you'll see that, Darko, every day, because that's what's really happening in these markets. Okay? Yeah, the origin of the breakout. Don't worry about rally base or drop base or anything like that. The most important thing you can do is look at the origin, is find strong moves in a market, and then go back to the origin of that strong move, and hopefully now you'll understand exactly why that strong move happened. Okay? Yeah, Jenna, whether it's, yeah, James, origin there. I'm trying to catch up on the questions. Jenna, so, yeah, whether it's based on fundamental news or some technical picture, yeah, there's no, a consistently profitable institution or bank is never going to chase the market. Okay? You just want to find out, Jenna, where they got in. And you can find that by going to the origin of strong moves. Okay? Because the bigger the order that comes in the market, the bigger the imbalance. The bigger the imbalance, the stronger the move. Yeah, Michael, if there was nothing to the left, yeah, I would feel comfortable just buying a breakout. Okay? Like I said in the beginning, I hardly ever do that, but at times where there are, you know, there's nothing to the left, you could buy this breakout if you want to, but make sure you look to the left first. That's the key. Yeah, and AB, that's going to be different in really every market. We'll take a look at a lot of examples here. Okay? Your stop loss is going to be just on the other side of that, of the origin of that breakout there. So let's look at some more examples here. Okay? So now, let me grab another one for you. So on this one here, again, we have a level of resistance over here to the left, and then prices eventually break out. Okay, but notice they don't break out in strong fashion. It's really a grind to get that breakout up even a little bit, right? Again, the reason why that happens is because those breakout traders are met with significant supply. So let them do all the dirty work for us. Let them remove all the sellers, which are really the enemy when we want to be buying, right? Let them remove all the sellers there, okay? Because when price comes back to that level, okay, that's where it's low risk to get into that market. Okay, again, another reason to wait for that pullback. Okay, here's just another one. I'll run through some of these pretty quickly. We're not going to spend much time on all of them. Okay. Again, just the opposite here. If we're shorting, we want to see, you know, we want to see that the demand. Okay, here's another one for you. Everybody see the chart? Okay. So we have a demand line in here connecting those lows, but we want to wait for a significant breakout, not just a little blip through the line, but let prices really fall from that level. Okay, you want to see that there has been a major supply and demand shift at that price level. And when you see that, and what's going to tell you that is a nice strong move away from the level. Okay, and once you have that, I look to sell on a pullback to the origin of that breakout, back up to that black line. Okay? Because now, again, two things are in my favor. Number one, I have a low-risk entry back up at the origin of that level. Number two, I know that the original sellers that shorted this breakout, look at all these candles on the original drop, lots of candles. So the second thing is I know that all those sellers there really helped me out and helped remove all the significant demand at least down to where I have my arrow right here. Okay, all the significant demand has been removed by the original sellers on that breakdown, at least down to where I have my arrow right now. So that when price comes back up to the level for the low risk short entry, it most of the time moves very quickly back down to, the low of this original drop. Okay? It's because there's really nothing to stop it from falling at this point. Does everybody clearly understand that? It's really like the snowplow effect. Do you want to walk down the street drive down the street where the snow has not been removed, or do you want to find the street where the snowplow's already been there? It's a totally different experience. And I live in Chicago, so I get a lot of practice at that. All right. Just maybe one more example here of a short, an area to sell short. So again here, what was support, as soon as you break down through it, becomes resistance. But find the origin of that drop. Okay? Find the origin of that drop and understand that it's fairly low risk, high probability, and higher reward to sell short on a pullback to the origin of that drop. Okay? Not a whole lot to talk about there. One thing I haven't mentioned that's on all these pictures I'm showing you is that we're trading in the direction of the trend. When the trend is up, we're looking to buy pullbacks to the origin of breakouts. When the trend is down, we're looking to sell rallies into the origin of breakdowns. All right? What's the best time frame to operate this? Any time frame, doesn't matter. Okay? False breakouts now, that's exactly why we're talking about this, because of what you're writing right there. Okay? A lot of people would consider this, if you look at this first breakdown here, okay, a lot of people would look at this breakdown and then prices coming back and say that's a false breakout. All right? There's nothing false about it. In fact, what I often find kind of funny is that, and this is not a knock on anyone, but we have these, you think of false breakouts and failure patterns. There are a number of books written about failure patterns in a market, right? Anybody see any of those books? I mean, there's failure patterns, false breakouts, false this, false that, but there's nothing false that's happening, and certainly there's no pattern there's nothing failing about a pattern. There's nothing, I should say, failing about a market, right? It's only because the average person looks at markets and understands trading the wrong way. That's why we have to give these things titles like failure patterns and things like that. Okay? All right, so nothing's failing at all. Supply and demand does not fail. It really can't. We're just talking about buyers and sellers here. Okay? Martin, that first or second time is usually your best time. If price has been back to a level a couple times, you might not want to consider taking it again. Okay? All right, let me get into a little different picture here, and then I'll catch up on any questions you might have. Just take a quick little look here at some conventional chart patterns. Whatever you're trading, long-term, short-term. If you're looking at, if you're trading short-term, maybe you want to look at a trend in an hourly chart. Okay. Yeah, one jam. Even if there was a rally there, when prices break down, when you let them break down, if you notice, the first move was to the upside, but then once they break down through that level, it's over. Okay. There are no buyers left once you break down through that level. In fact, the reason they break through is because there's actually more sellers than buyers. Okay? Yeah, Bobby, I'd probably go with something a little bit smaller myself, maybe a 50-period moving average. Okay? And it's just because of that supply and demand shift, and the chart tells you all that way in advance, way before you want to take your entry. So just quickly on this one, again, if you're just not going to take the pullback, and you just want to short right off the bat here from this kind of triangle pattern that I know a lot of people look at, I don't necessarily trade this, but okay. But before you push the button to sell short at the short entry, make sure you look to the left and figure out where your support levels are. If they're too close to your entry point, don't take the trade because the trade's probably not going to work. Okay? Just like here. So in that example, maybe you end up taking that trade, but in this next one here, even though you have the same pattern, notice that support or demand is way too close. Okay, you probably don't want to take that trade. All right. Okay, so make sure that you look to the left and you figure out where your opposing supply or demand level is, and make sure you have a profit margin. That's the key. Okay. Yeah, Nick, you don't have to always do it. I mean, I'm suggesting that you always do it, but the truth is, if you just look to the left, for example, in this euro now, let's go back to some live charts here. In the euro here, if this circled supply level was not there to the left, Niv, it's usually okay to buy that breakout because price is probably just going to keep going until it hits supply. That's what happens in markets. AB, if you haven't learned the patterns yet, I would suggest just forgetting about that and just watch the price action because the price action is going to tell you everything. Okay? Keep it easy on yourself. Keep it simple. All right? It's very easy to make trading complicated, believe me. Another reason why we'd be looking at this euro, and I'm going to pull up a workspace here. I wasn't going to do this, but let me do this for a minute. I'm going to pull up a workspace right out of our trading room. Okay? And let's see. This is if you look at the charts on the top here. Let me just bring these up. Is anybody in the Online Trading Academy Forex room? Yeah. Okay. AB. All right. So we do have one. Okay. So. Oh yeah. Yeah. Talk about the XLT. So yeah. So if you're in the room, we've had these lines in for literally, at least on this chart in the upper left, we've had them in for months, and then just a few days on the chart on the right. But I think, have we looked at this chart before in here? I think we have. So you remember probably we've had these lines in for a long time. So just over the past week and a half, the dollar index has reached this supply level that we've been looking at. Okay? Why is this a supply level? Clearly because, again, we've got some trading here and then a strong collapse in price from this level. Recently, over the past week and a half, we've just come back into this area, suggesting that the dollar has room to fall. If the dollar index is going to fall, which currency is going to benefit on the long side the most from that? Which one's going to benefit the most? Yeah, it's going to be the euro. Okay, the euro takes up the biggest chunk of the dollar index pie. Okay, the others as well, euro, yen, pound, and the others. They're certainly, we'd look for entries on the long side in those too, but certainly the euro. Okay. On the smaller time frame here, again, you look at the origin of the breakout and then short the pullbacks. That's what we've been looking to do in the room there. But having said that, knowing that we've got some serious supply here in the dollar, we come back to the euro. We see we've now got some serious demand below. Can everyone kind of start to see the big shift that's happening here? Okay. We're looking at a couple kind of big time frame trades here, but in Forex, that's fine. We want to take advantage of those big moves. Okay. Is it too late to short the dollar index? Remember, the low risk place to do that is up at the supply level, which it's certainly not there right now. Okay, it was over the past week and a half a couple times. We've been watching that, but we can certainly watch for pullbacks in the euro to support, which means if the euro did pull back into support, that means the dollar's probably back up at or near the supply level. Okay, so you can see the shift in these currencies happening in the bigger time frame. You can also see it in the smaller time frame, just like we saw with the dollar index there on the hourly chart. Okay. So watch for that. We want to let the demand here in the dollar be eaten up so that prices can go lower, just like we want to see the supply eaten up here in the euro so that if and when prices pull back, we haven't had a pullback in this yet. That's the key to understand here. So there's no stress in jumping in this. And this is something I see in the Forex room. New people that come into the Forex trading room all the time, they just always want to jump in the market, and they want to catch every swing, every little 5-pip move. People want to catch that. That's not real-world trading, okay? That's not how the consistently profitable buyers and sellers do it. Instead, let these moves happen, understand why they happen, and get in at the origin of those big moves. And usually, that's where the bigger move usually comes after that pullback anyway, right? And if you think that logic through, it really has to, because prices can't move up significantly here until all this supply in the circled area is gone. The only thing that's going to remove the supply in the circled area, okay? The only thing that's going to remove the supply in the circled area is absorbing that supply. Price has to go up and sit there and do that, okay? So that if and when price comes back in the euro, typically it's going to move up much quicker after that pullback, okay? It's much lower risk, much lower stress, okay? We want to enter positions as close to our protective stop as possible, and that's only going to come at support and only going to come at resistance, okay? By the way, I probably should have said this in the beginning, but when I use the words demand and supply, I'm simply interchanging them for the words support and resistance. Why do I do that? It's because, most people have a different definition of support and resistance. For some people, it's a pivot high and low. For others, it's maybe a moving average. For someone else, it may be a Fibonacci line. For somebody else, maybe some Elliott wave points. So if you call things just support and resistance, chances are I might be reinforcing something that maybe isn't 100% accurate. Yeah, and as Darko's typing in there, supply and demand equals resistance and support, why not just call it what it really is, which is really supply and demand, okay? Candle tails, Mike, I don't pay too much attention to those, and here's the reason why. It's because every time you see a candle tail, it's only a tail because of the time frame you're looking at. As soon as you change the time frame, that tail may become a candle body, and vice versa. So if you give that too much, that too much importance, you might be running into trouble there. Okay. A little bit AB, but the most important thing to watch for there, I wouldn't pay too much attention to that. Just watch for the breakout, the strength of the breakout. Okay. Yeah, FOB. There's nothing wrong with momentum intraday trading. Just don't get in while the momentum's underway. Get in at support. Okay. Get in at support or demand, and then get paid as prices start to move higher. Then the momentum traders jump in the market, and they're going to come in and pay you. You follow me? Okay. And obviously that trade duration is going to be much quicker than your swing trading. Okay. But the concept is the same. All right. Yeah. As Nick is pointing out here, a very important point. It's going to be these are going to be higher probability trades, obviously, when you're trading in the direction of the trend. Okay, when you're trading in the direction of the trend, these are certainly going to be higher probability trades. Okay, Rob, it all depends. If you're looking at a 5-minute chart, you can have the whole thing play out in minutes. If you're looking at a daily, weekly chart, it's going to take longer, but the concept doesn't change. In fact, let me show you. This is a longer-term chart, but in the trading room, this is one of the pages I bring up here, and I've just brought this up because this is a trade from the other day. Okay, and this is our short-term trading page, very short-term. All right, let me just bring this up and show you this. Okay, here's just a 5-minute chart at the end the other day. Can everybody see the circled area on top in the chart? Everybody see that? It's just a 5-minute chart. So notice how prices break down from that area. Okay, they break down in price. They absorb whatever demand is over here to the left. We didn't short on this breakdown. Instead, we shorted when prices came back up into the area. I have one white line down here and another one way on top of the chart. Looks like a big stop here, but it's not. It's really a small stop. This is only a 5-minute chart. So we shorted when prices came back into our supply zone. We create demand and supply zones in the trading room. So we shorted when prices came back into the zone, and we're in for the move down. But this is exactly how we do it. Okay, and FX clans, yeah, FX clans, he's calling this a double top, and that's fine. But remember, the way we enter the double top is very different than the textbooks. Okay, what we do is real world trading. What we want to do is real world trading. So instead of waiting for price to break down and then getting in after you have a double top, we're selling short at the origin of that move so that we are a part of that double top. So by the time it becomes evident to everybody else out there that you have a double top, you want to be in already with the low risk entry and get paid from everybody else that takes that kind of conventional chart setup invitation. You follow me? Okay. All those pictures in the trading books, wouldn't it be nice if you were in those already when they're evident so that everybody else would come into the market and pay you? That's the key to being consistently profitable. That's all we're talking about here. All right. And on that note, I know we're kind of out of time here, but hopefully today was helpful. And we are certainly going to, we have another session coming up this month, and we will spend that. What I typically do with FX Street webinars is I'll spend one session being very educational like today, and then the next session we'll spend being very just really looking at the markets. Let me type my email address in here if you have any questions. So here's my email address. Okay, so yeah, FX Street has it there, March 26th. There's my email address, by the way. We'll see you back here towards the end of the month, and we'll put all this stuff into practice and look at charts and find some setups.